Mining Network's coverage of the WNS is brought to you by GovEx Uranium.
I'm joined again with Rick Rule, the founder of Rule Investment Media and Battle Bank. Rick, good to be with you again.
Pleasure to be with you. Thank you for having me back.
Look, I wanted to start actually with recognizing that I was wrong and you were right. We spoke at PDAC back in March, and you were telling me that the Doge department and the whole slimming down of the deficit was all theatre, and I, like Elon, believed the theatre, the rhetoric. I guess now more than ever, you're probably the thesis on that side of things is looking more true.
Age, I think, makes you more cynical politically. And I suspect that when you turn 72, it's a mistake that you won't repeat. You're a fast learner. I lived through the Reagan Revolution. Mr. Reagan was elected with a broad mandate to reduce the size of government. In his wonderful book, The Triumph of Politics, David Stockman details how political actors in Congress on both sides of the aisle, Democratic and Republican, derailed the Reagan Revolution within 6 months of inauguration, given the very slim margin that Mr. Trump was elected by, and given the entrenched interests against fiscal sanity. If he ever intended to do the right thing, which I doubt, he had no chance.
Yeah. Well, we could talk about this for a while and a topic for another time. But today I really wanted to bring you on to talk about the uranium market, as we were talking about off screen. It's the World Nuclear Symposium is on next week in London. We're attending. Everyone in that game will be there. It's going to be a huge learning opportunity, and hopefully we're going to be sharing a lot of those insights live at the show. But I understand you're taking a trip for, I think, quite a while around Africa and enjoying yourself, so you won't be able to make it. So I thought, let's have a chat here first.
I will, in fact, be in Africa with my wife, which I consider to be a more pleasant, if less useful, use of time. Failure to do so might result in an overnight bear market, which would cause me half. I can't do that. I am sorry I can't be there. I will have a lot of close friends there, and I expect a reasonably accurate reporting of the conference. And I think it'll be a uniquely interesting conference, given all the various forces converging on the uranium market right now. I think it'll be a lot of sound and fury. I suspect that people will need to work 8 or 9 months to digest the information that they pull out of the conference and make it useful for them.
What I'll do, any notes I can gather, I'll send your way, given you can't make it. But I think you're right, though. It is an interesting time, and one of the reasons I wanted to talk to you more than anyone else about uranium was you've been calling uranium as a long-term play back when it was extremely unpopular to do so. I remember being at conferences back in 2017, and you're the only guy in the room talking about uranium, and everyone's scratching their heads. But lo and behold, your thesis, and it's a similar thesis that we spoke about that you have with nickel now, it is starting to come true. And I guess just to lay out the groundwork, where are we at the moment in this uranium bull run? Because we've sort of, it seems like we've come out the woodworks, but there still might be a little bit of a way to go left.
It wouldn't surprise me if the junior equities are a little overheated. Perhaps a year ago, they were roundly hated. I mean, ridiculously hated. You'd look in social media, and posters who had had uranium as part of their internet handle were bemoaning ever learning how to spell the word. And there was a lot of hate around the stocks. The consequence of that was that I added to already large positions, feeling that when the hate subsided, that the equity prices would recover. That happened. And those extra positions that I held, which were not core positions, but rather trading positions, have now been sold into the market. I didn't own them as investments. I owned them because I thought that the share prices would go up as a consequence of their going from hated to tolerated, not yet to loved. So I think that's important. I have continued to add to my Cameco position. That wasn't a trading position. It was a core position and is a core position. My fear around Cameco, as you and I have discussed before, had to do with their acquisition of Westinghouse, and my fear that a mining company couldn't manage an engineering company or a processing company. The first couple of quarters after the acquisition, what I suspect happened was that Cameco executives cleaned house financially, and the reports out of Cameco were not good. The last 2 quarters have been spectacular, which suggests either that it's a better business than I thought, and I thought it was a pretty good business, or that these guys are better managing it than I thought. Suffice it to say, Cameco would seem to me to be the powerhouse in uranium if they can pull off the transition from being merely a miner to a company that really is vertically integrated in uranium and whose ultimate product is watts.
Do you think as well they've been helped somewhat with some supply disruptions and some reduction in guidance coming out of Kazakhstan? I'm assuming that's sort of helping the Cameco share price a bit.
I think that's right. I think the geological potential of Kazakhstan is still very high, and I know that even in country, they have the technical expertise to solve their problems if they choose to do so. The conundrum I have with Kazatomprom is the turnover that they've experienced at middle management. I don't understand what has happened or why it has happened, but some of the technical people that I was profoundly impressed by 10 years ago, many of them have left the company. I don't know why. And when there are circumstances that feel like risks to me that I don't understand, I sell the stock, which I have done with Kazatomprom, despite the fact that I think potentially they're the best uranium miner on the planet. If you miss the people, those resources are latent. They can't be brought to account.
Welcome to GoVX's Muntanga uranium project. It is right next to the Kariba Dam, a 4-hour drive from Zambia's capital, Lusaka. It has great infrastructure, benefiting from road access and proximity to power lines. Zambia is a pro-mining country, and we have the support of the government for our project, which is going to be Zambia's first uranium mine. Our Muntanga project is already mine permitted, and it is a simple open pit heap leach operation.
The feasibility study is complete, and we have filed the ESIA and relocation plan. GoVX has recently announced a reverse takeover of Tomador Iron, which will result in an Australian listing, a new name, Atomic Eagle, a strengthened balance sheet and corporate structure in a market that knows Africa, supported by a proven uranium team.
Yeah, well, it's never a good sign. I mean, any business you're in, if the best people start deciding to leave, you do start to wonder if there's fundamentally something not going right within the company itself, right?
If I came to understand the interplay between Kazakh politics, which is to say domestic politics, which I have heard is the reason for the staff turnover, and if I came to understand how the staffing, in terms of their competence, was appropriate to the task at hand, and I had faith that the human resources could physical resources for the next 10 years, I'd be back in Kazatomprom like white on rice. I've learned in my life, as I say, if there's risks I don't understand, the right thing to do for me is to exit the investment until I understand it. At age 72, Peter, hope is not an investment strategy.
Well, I get that sometimes when I'm you did a really great video a while ago on investing via private placements, and I think that the core of the thesis that always stuck with me is if you've put the money in and they've done what they've said they will do, then you invest again. If they haven't and they've failed to achieve it, you need to take the money out because it's failed. Usually,
With
there's
the caveat that it's a function of price. If they've done what they said they're gonna do and the price reflects it, you might sell in.
I think from memory, it's been a while since I watched it, but you said something along the lines of, if say for example they're paid to do a drill campaign, the drilling's completely failed, it's all duffs, you get the money out as soon as you can, right? And it's so easy if you miss that first wave of selling, and the share price is already down. It's so hard rationally to try and take it out, right? And I guess yeah, your years of experience has probably you've got a stronger stomach for doing so.
That shapes our whole discussion here. If the reason to own a company goes away, the stock must go away, irrespective of whether you're up or down.
Yeah, no, agreed. But just looking at the uranium thematic, I mean, and this is something that I'm really interested in learning about next week, is structurally, if you look at the uranium market, I've been looking at a few different forecasts, but most analysts will agree that by 2040, we're looking at a doubling of supply that's required to come online. You're looking at hundreds of new reactors, either in the construction phase or in the planning phase, or just before that. And when you look at the actual supply that can come online, I think you've got MacArthur that obviously can ramp up. If maybe let's say Cigar Lake gets up to full capacity, Arrow could come online. There's a few projects in Africa and Niger, but it doesn't really seem like they match up correctly. And really, structurally, there's just been this huge underinvestment in uranium, and it's now. I guess the real question is, it's a timing thing, right? Of are we there yet, or are we still waiting for this to happen?
I suspect by 2040 that given other changes in the uranium market, in particular the increasing prevalence of term contracts, that the industry will be able to meet demand. I think the problem comes sooner. Um, we have a supply deficit now, and that supply deficit, I suspect, has been met by uh, inventory from the slowed pace of Japanese restarts. 10 years ago, when the Japanese industry didn't know if they were restarting or not, they sold surplus inventories. Now they're doing something very different. They're leasing surplus inventories. They're lending the uranium to other reactors for refueling against the delivery of similar amounts of uranium with interest later. So, in effect, what we're doing is we're cannibalizing future supply, which is fine. That's a good thing. It's important to note when you discuss 2040 that the net present value of demand that occurs in 2040 in 2025 is irrelevant. It says something to the structure of the industry, and it says a lot about the tail on a net present value curve. What matters in the very near term, I think, is uh, the real pace of Japanese restarts, which is to say, it's now occurring politically rather than physically. So it needs to occur physically. And importantly, most of the demand forecasts that we have forecast the shutdown of a lot of conventional capacity in the West, including in the United States, that likely isn't going to shut down. So the demand forecasts, the slope in demand forecasts around facilities that were slated for closure but won't close impacts demand in 2026, 2027, 2028. And the net present value of that is much higher than the net present value of demand that will occur in 2040. What I hope will be discussed, Peter, among the financial types at the conference is the potential impacts on the cost of capital for developers from the transition from the spot market to the term market. Uranium is currently the only commodity in the world that I know of where producers and would-be producers can enter into contracts that specify volume and price within bands 5 years forward, 10 years forward, 15 years forward, 20 years forward. And what that means is that lenders like myself have some certainty as to revenue at the project level, which de-risks the project from our viewpoint, and likely over 4 years or 5 years lowers the cost of capital, both debt and equity, to the uranium sector. It also gives smaller developers the financial wherewithal to build deposits. They don't have to sell these deposits to big companies that can build them on balance sheet because they can, on the one hand, sign a fixed price mine development contract with Cameco, Westinghouse, and on the other hand, sign offtake agreements with credit grade counterparties. Tokyo Electric Power, China General Nuclear, Duke Power, Southern companies, and literally take those to the bank. That doesn't mean that smaller companies might not sell the deposit to larger companies and save themselves the brain strain of building a mine, But it means that they can say to the bigger companies, to the Rios, to the Camecos of the world, if you don't pay us well enough, we'll do it ourselves. And this is truly a sea change in the uranium business, and it makes uranium unique among other mineral commodities. I realize that this sort of green eye shade response doesn't excite investors. Investors want great big themes and all that kind of stuff. But it's probably the most important single factor around the pricing of uranium equities in the market today.
Does that, in your mind, then lead you to believe that if we are going to see M&A in uranium, then it almost has to be at a premium?
I think it does mean that. Understand that I'm not a bull on the length and breadth of the uranium sector. I think there's 110, 120 listings that purport to be in the uranium business worldwide, and probably 50 are viable. So I wouldn't want your listeners to extend what I had to say through the length and breadth of the uranium penny dreadfuls. If there's price certainty around a commodity that you don't have any of, it shouldn't impact your share price. But for the companies that have legitimate development projects, the access to capital afforded by certainty with regards to price and volume is a real true sea change. It makes uranium in its own way, at least high quality deposits, a better business than the gold business or the oil business or the nickel business or the potash business. It's unique. And by the way, I really truly believe that fixed price agreement or contractual price and volume agreements, like you see in the uranium business, will begin to become standard in other commodities too. I believe that shareholders will ultimately say, "I'll trade off some of my upside for the elimination of my downside."
Yeah, well, we do see those hedges happen quite a lot in mining, don't you? It's with the uranium spot price, the way that you're talking in terms of sort of you think the supply and demand will be sort of fulfilled by 2040. Obviously, we've got a short-term period at the moment where it's trying to catch up, and then obviously we've got other factors like Japanese sort of leasing and whatnot. Obviously, I think only about 80% of uranium sales are actually, what's the word, voluntarily shown on the market, right? It's still quite opaque. How do you have confidence in, I guess, any direction that the price could be going? And I guess on a follow-up to that, how much of an influence now does the SPUT Physical Uranium Trust have on spot pricing? Because it seems like that market now is moving more with news around SPUT than it is around other fundamentals.
Well, let's disclose conflicts of interest. I was in history one of the authors of that product, so I'm attracted to it. I'm also, I believe, the largest shareholder of SPROT. I'm not an officer, I'm not a director, but I'm a large shareholder. So there's some conflicts of interest inherent in this answer. On most days, the dollar volume of the SPROT Physical Uranium Trust exceeds the dollar volume in the spot market. So one could say, in some senses, that the spot market is the SPROT market. When Sprott did a non-market related financing at a premium, and the market could see that there was a buyer coming into the market that would never be a seller, the spot market went up in anticipation of the Sprott market, which is to say, the tail wagged the dog. And I think that's important. That product, the Sprott Physical Trust, has become the mechanism by which investors express their optimism or their pessimism around the uranium price. If you, as an example, Peter, were excited about the future of the silver price or the gold price, you could go to your dealer, buy some, and either store it in a vault or store it in your basement. There are some very sensible rules precluding you from storing uranium in your basement. Uh, the retail buyer in uranium cannot supply liquidity on the buy side or the sell side. The Sprott product is unique in the sense that the investor can express his or her preference on the long side, but not on the sell side. The Sprott Physical Uranium Trust cannot sell uranium. Uh, in effect, it's Hotel California. The uranium can get in, but the uranium can't get out.
But how much does, I guess, that in a sense, obviously from what I understand, they're hoovering up any excess supply at the moment, right? Which obviously would be supporting the uranium price as it is. I'd imagine if they weren't doing that, we potentially could see a lower uranium price as we sit here today.
In the very near term, what you say is correct. Prices are set on the balance between supply and demand, and particularly the Japanese utilities, which at one point in time, well, at one point in time, they had infinite inventory because they weren't using any. Uh, Traditionally, the Japanese utilities, because they didn't produce uranium, and because uranium was the most important source of base load power in Japan, had 5 or 6 years of inventory relative to 2 years of inventory for reactors elsewhere. So it's very hard to overstate the impact on the uranium price that happened as a consequence of Fukushima when those massive inventories became surplus. It's in the near term very difficult to overstate the extent to which the near-term price of uranium is driven by the true pace of Japanese restarts. In other words, you promise to restart a fleet of 40, but you restart 14. That means that there's latent demand from 26 reactors that the market needs to address. As the market addresses that, there will be uh, continued turmoil on the supply side, particularly, as I say, because the inventories in the last 18 months appear not to have been sold by the Japanese, but rather leased, which is to say that the reactors that bought that uranium must buy the replacement fuel at the same time as they have to repay the Japanese for the fuel they borrowed.
So how long are these leases typically, and when did they start?
That's very opaque. The most honest answer, Peter, would be I don't know. Similarly, with regards to these long-term supply contracts, there's no current requirement, depending on management's interpretation of the importance of the contract. There's no requirement that the details of these contracts be released to the public. And very large suppliers, as an example, Cameco, and very large consumers, China General Nuclear, regard their contracts as proprietary price information. In other words, they regard their contacts as material information around the structure of the uranium market, and they're loath to release it. I'm sorry. What will happen over 5 years is that the companies, particularly the smaller companies, that voluntarily provide data around contracts to the market will enjoy a lower cost of capital because of higher investment certainty. This won't be something that will occur as a consequence of securities regulation. It's something that will occur as a consequence of cost of capital. If I'm a lender right now doing project finance uh, to a non-investment grade issuer, that loan may read 8%, but if you add in the bells and whistles, it's 15% cost of capital. That's what it is. And with proper information around uh, uh, future revenues, that cost of capital can fall from 15 to 9. And that's a material advantage. At the same time that a credit analyst can look at revenue forecasts with increasing certainty, an equity analyst can do the same. An equity analyst can look at a company that has certainty around price and volume 10 years out, 15 years out, and make a much more accurate financial model than he or she could without any price certainty going out. And this really, truly changes uh, the structure and potentially the cost of capital for the uranium industry.
But does it not supply it sort of come with its own risks in a way though? If you're obviously, for example, I think NextGen they went out and bought um, a load of uranium, I think a year or two ago, just in case they don't get the mine in production on time, and then they've got these lease agreements, all these agreements to sort of supply the uranium. Obviously mining is notorious for cost overruns and delays. If we see all of these junior miners going down these contracts, are they not? Some of them would surely be at risk, wouldn't they?
Absolutely. But history will show not as much risk as making an enormous capital investment and then having the floor price fall out from under you, or uh, paying 15 or 16% cost of capital when you could have paid 9. Uh, what investors object to with the long-term contracts is that the issuer gives up the upside volatility in the uranium price. When I was in my 20s, I would have objected to that too. Now that I'm in my 70s, I've learned that if you take away a bit of my upside in return for which you eliminate most of my downside, that's a pretty good trade.
Yeah, agreed. I want to go back onto the Japan side of things as well, because I did have a follow-up question to that a minute ago. Uh, it sounds as though with them leasing out a lot of this uranium, there will come a point, whether it's in a year's time or 18 months or 2 years or however long these lease agreements are, obviously we don't know, but surely that could trigger, I guess, a tightening in the market quite dramatically as soon as they need the uranium back.
Well, tightness is a function of price, isn't it? Uh, we'll see. That question is the stuff of inflammatory headlines, but the truth is, I don't know what will happen. Uh, I I suspect that the price creeps or perhaps surges higher. I if you when you look at the teething problems that have been encountered with greenfield projects put into production, be it Boss or Inkai, what you see is that the all-in sustaining cost numbers that the industry's assumptions, at least the investors' assumptions, are being based on, are low. Uh, I think a very, very, very different consideration, Peter, for your listeners, will be incipient inflation. What that means is that a mine like Arrow, where people are suggesting will cost $6 billion, won't. It'll cost 11, because all of the inputs associated with that mine are increasing, and they aren't increasing by the CPI stated rate of inflation at 2.6 or 2.7. They're increasing more like 8 or 9. That should make long-lived incumbent assets, where the upfront capital costs have already been put in the ground, substantially more valuable than people believe.
Also, even on that, not even just the upfront capex cost, but obviously something that we had been doing. A lot of these companies had been creating engineering studies and feasibility studies and doing a lot of this work in a very low price environment in uranium, talking about $20, $40. How much do you believe the all-in sustaining costs, once they're in production, from the economic studies that we are seeing from the developers?
I'd rather not answer that question. I'm doing some work on it. The people who used to help me do that work, Sub Rosa, 10 years ago, worked at Kazatomprom. And so my Sub Rosa, uh, brain team, sadly is out in the ether.
Right. But so it sounds like it is something that you are thinking about, though, given that you're doing some research on it. So it is on the radar that is something that you're looking at.
Certainly, at Inkai as an example, steady state AISC before it was shut down was something like $15 a pound. Uh, AISC, and it might be transitory, but AISC is something closer to $50 a pound now. Well, I'm not sure really why that is. I'm just sure that it is. And that's of interest to me.
Does that, with these long-term contracts, and like you were sort of talking about, reducing some of the downside risk, does that then inherent a risk of, if inflationary pressures do go up too much on the ASIC, then you could actually be in quite dangerous territory?
Yeah, I suspect, as an example, if you're Lotus or Paladin and you think you can build a plant for $1 billion, and Cameco/Westinghouse comes along and says, "We'll build this for you, turnkey, no ifs, ands, or buts, $1 billion too." You take that you take that deal because you can't take the upfront capital risk and the completion risk. And if you take the contract with Cameco to Duke Power or Southern Company or Tokyo Electric Power, they are much more likely to sign the contract because they believe that you'll be able to deliver. And it is entirely likely that if you went to Cameco/Westinghouse and did a turnkey contract to build the mine, that they would in effect underwrite or provide assurance of the issuer's ability to meet the long-term supply contract. I could see Cameco with their trading capabilities, their reprocessing capabilities, their mine construction capabilities, and their production capabilities. I could see them, in effect, becoming an insurance company, guaranteeing the supply side of long-term contracts in return for getting premium contracts around mine construction and development, and also perhaps from utilities, reprocessing and enrichment fees.
And would that approach be more attractive than the traditional M&A approach, do you think, for someone like Cameco?
I think it would complement it. Uh, Cameco will always be in the catbird seat with regards to M&A because they're the only integrated player in the space. The recent announcement by Rio Tinto that they're going to focus on 3 core business units and de-emphasize every other commodity on the planet suggests that there's one less competitor in the uranium space. The most obvious major competitor in the uranium space is BHP as a consequence of Olympic Dam. Uh, I don't know that BHP knows that they have a uranium business, given the size of the rest of their businesses. But right now, Cameco would appear to be in the catbird seat. I know from talking to people at CGN, China General Nuclear, that they aspire to build a globally integrated uranium business too. And the Russians, before their incursion into Ukraine, had similar aspirations for, their own Kazatomprom. But right now, it looks like the global hegemon is Cameco.
It's interesting you say, obviously, the growth ambitions of China and Russia, and it's something we were talking to with Joe Mazumdar, actually, back in PDAC, was he was focusing more this year on investing in assets that had the dual approach where they could be purchased by either a Chinese company or a Western company. And so therefore you're looking at places mainly in Africa or South America or whatnot. Is that something, well, essentially, so you can have a bidding war, I guess, but is that something that interests you, or are you more interested in safer jurisdiction, but obviously you do have that delayed permitting risk?
I don't believe that there are safe jurisdictions. I believe they're all lousy to a different degree. So for me, it depends on the interplay between the size of the prize and the certainty of the rule of law. Um, I understand Joe's point, and I suspect, as an example, the changing political winds in Niger will give both the Russians and the Chinese the opportunity to participate in the industry, principally to the disadvantage of the French, but perhaps to others too. I, I mean, the high quality assets, some of the high quality assets at least, continue to be Canadian assets. And I do not believe that currently the politics in Canada or North America would allow Chinese or Russian participation in a meaningful uranium project in Canada. I don't think that there would be any such objection in Niger, Tanzania, or Namibia.
Yeah. No, agree. But does that then, if we're talking about premiums on M&A, does that then mean that places like Namibia and Tanzania and Niger and Zambia and whatnot almost become, if you're playing it for that purpose, that therefore then becomes a bit more appealing to an investor?
The risk is that the process by which those auctions are conducted might be compromised. It might be that some of the yield in the auction is siphoned off by political forces. In other words, the state might benefit more from the process than would happen elsewhere, or actors, state-sponsored actors might benefit, and the benefit might not filter down to shareholders. It could be, and I'm not saying it would be, but I'm saying what I guess I'm saying in Niger is the deposit. A deposit might not be sold to the highest bidder on behalf of shareholders, but rather be sold to a bidder whose uh, bid benefited players connected to government or the government, and you really need to consider that in a jurisdiction where the rule of law is still being worked on.
Yeah, it's not as if we haven't seen that, especially in places like Niger and Tanzania in the past.
Well, frankly, if the Canadians constrain uh, who the politically correct bidders are for Canadian assets, it's the same political risk, just political risk manifested by white people in English.
Yeah, true. Um, I guess to close things up, you were talking about gold at the moment in terms of cost of capital and uranium obviously looking a bit better. If you were looking at investing into either the physical, say like the SPUT product or a gold ETF today, which one would you? And I know there is a little bit of conflict of interest there, but I hope you'll tell the truth and what you mean, which I'm sure you will. But which one would you be looking at today?
As a 72-year-old who actually doesn't need to make money, prefer to maintain his purchasing power. In my declining years, I've become, with most of my portfolio, a coward. And so I prefer gold. My own portfolio, let's just say I save in gold and I maintain liquidity in US dollars. Uh, Speculative part of me, and although I don't need to make money, I like to make money. The speculative part of me, in terms of the physical ETFs and similar products, is concentrated in uranium and silver, which I believe have more upside volatility. I need to say that my holdings in the SPUT Uranium Trust, if you looked at the way I traded that trust, you'd actually think I was a pretty good trader. It happened mostly by accident, of course. I allocated commodities, and I loaded up on the thing when it was cheap. I managed to sell enough that I got the rest of my position for free. Uh, a totally freak occurrence. I wouldn't suggest I was a genius. I just bought the stuff when nobody liked it, and I sold it when people did.
Yeah, but
Simple as
you've
that.
been doing that your whole career. It's not as if you've only just started doing that.
Well, I've always aspired to do that. With regards to uranium, I actually did it. Wonders never cease. But I would suggest that, for my core portfolio, my biggest physical possession is gold. I have a big uranium position, but it doesn't stand me any money. I've taken enough out of it. And I could do that with my gold, my physical gold position. Well, it's been established over 25 years, but a bunch of the position was established at prices that are materially lower. I believe, just based on history, nothing else, that the gold bull market that we're in has legs. And the consequence of that is, I believe, that the generalist investor will eventually buy into the precious metals narrative. And when that happens, I think it's probable that silver enjoys a real move. So the speculator in me has some physical silver and some silver stocks too.
Okay, so speculation wise, we're going silver, uranium, and for the tried and true, we're going gold. Okay, I like it. And just
Peter, if a financial planner looked at my portfolio, he or she would say, "You're out of your mind owning this stuff. You're a huge Sprott shareholder. If we are in a commodities and precious metals bull market, Sprott's AUM is going to double or triple. Their free cash flow, because the AUM related fees go up much faster than the cost. You already have a portfolio that's perfectly hedged to precious metals and natural resources." And that's true. But the truth is, with gold in particular helps me sleep nights. And at 72, that's a worthwhile investment.
Yeah, I think everyone in the industry just is overweight mining. I hardly invest in anything other than mining now, which is obviously, again, terrible advice because it's a risky game to play. And just on the uranium side, it sounded like at the beginning there you were saying you were loading up still on Cameco. It sounds like, and you did mention within there something along the lines of if you have the physical built mines, you're in a much better position, obviously. Are you still, if you are going to be looking at uranium investments, are you just focusing on the larger, well-established producers because of they're sort of holding all the cards right now?
Because I have such a large uranium equities position now, I'm increasing the equities, my equity position. I have a shopping list of 12 companies. No, I won't share it. And when any of those companies has a news event, negative news event, that I believe is temporary, not systemic, and the stocks sell off, I buy them. I buy bad news. And I have a core position. My core position will expand gradually as and if my net worth expands. Uh, but I try to, because I don't need to buy the stuff anymore. I've already done that. I tend to increase positions, with the exception of Cameco, uh, based on bad news that freaks out the market, where I think that the market reaction is overstated, and where the news is temporary, as opposed to systemic. In Kazatomprom, my nervousness is that the bad news is systemic. I don't know whether it is or not, but I'm not gonna hang around and find out.
Just on a final note, obviously we were talking about the conference next week, and obviously you weren't able to be. If you were there and you said you got some colleagues there, what fact finding, what things would you really like to find out next week if you were there? What are the big questions that need answering?
I would try, I would try to be buying some beer for the traders, for the Itochu guys, for all those guys. They're the lubricant in the market. And I would try to determine something about the flows. Uh, in the never mind in the interim, uh, but particularly in the period between the time when the price is adjudicated in the spot market, pardon me, and the time when the price is increasingly adjudicated in the term market. The owners of the information around the market are the traders. The second thing I would do, I think, is I would try to do a deep dive into the anticipated capital costs of the new builds, because I suspect that we're going to have some very negative surprises around that. Uh, I would also be on the lookout for very smart young people, much as I had found with Kazatomprom, who could help me on a going forward basis reconcile things like produced grade versus average mine grade to determine which companies during periods of low commodity prices were high grading. High grading makes the current results overstated, and also sterilizes some portion of the lower grade halo in the mine. And one of the things I've been able to do in my life reasonably well is avoid cost blowouts from the mining business, in the gold mining business, pardon me, that were a consequence of high grading. What happens during a period of high grading is that there's a 5-year catch-up period afterwards, which is really, truly ugly. That's one of the things that Newmont's going through, or has been going through. And I don't have the ability to do that in the uranium space right now, which is something that I would very much uh, like to get.
Okay. Well, I'm gonna go there and try and see if I can get any answers. But I'd imagine for some of them questions, especially the high grading, it's gonna be tough to find out. But I'll give it a go. Rick, thank you very, very much for your time today.
A pleasure. Thank you. It was fun to have an in-depth discussion on a topic that most people couldn't care less about. I enjoy that.
No, thank you. And enjoy your trip to Africa as well. Appreciate it.
Thank you so much. Have fun next week.